Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
If you also follow that purple line down, you notice it bottoms in there and then bounces up. That was the credit crunch low there, and it happened in July of 2008 is when the dollar started to really rally, when people realized how bad the global credit crunch was. And as the dollar started to rally, you also notice that before the dollar started to rally, the current account started to improve. Now, if you think of this current account deficit as more than just the U.S. trade balance and service balance problem, also think of this black line as U.S. dollar credit into the world, because the bigger the U.S. current account deficit in general, the more the dollar-based credit is out there. It's not a direct relationship, but it's a good thumbnail sketch. So that improvement in the current account deficit, the black line going up, we also noticed that the dollar bounced at the same time and went up with it. That's the idea of people taking money out of the global economy and come back into the U.S., and I think everybody knows that story because of the credit crunch. They hit in the U.S. bond markets, and it tended to help the dollar. So the point being, the current account deficit now has improved 50%, but you may remember before the current account deficit started to improve, before any of this happened, most of the so-called I guess you could call it academic and Keynesian type economists that were respected and still tend to be for some reason in the financial community had said that the U.S. dollar has to depreciate another 30-40% from where it was, even though it was approaching a low, an all-time low, in order to rebalance the current account deficit. The idea being that the U.S. dollar has to fall so much in order to increase the amount of exports in the U.S. Well, again, we saw a 50% improvement in the U.S. current account, and the U.S. dollar is actually above its all-time low. So there goes that theory right out the window, number one, and I want to make that key point. Now let's start looking at some of the other trading partners against the U.S. and evaluate some of the differences here, and you can see why I think there's a real change in perspective here in just the way the global economy was funded. Let me go back here a second. Steve, can you still see the chart? Okay?
Yeah, perfect, Jack.
Okay. Steve, how would I go about grabbing the pen? I'm sorry. Keep going back and forth. The little pen so I can mark on the charts?
I can't see it because it's so large. It's full screen since I've given you control.
Okay. Let me see. I wanted to grab the pen so I could mark on here for some of the... Oops. I'm sorry. I think we're gone here.
Yep.
Sorry, guys. Hang on a second. I wanted to grab the pen to mark the chart so it's not so esoteric looking. Still have the ball here, so we're doing a share the desktop.
Let's see.
Okay, can you see that okay?
It's coming in, yep. No, now we're just seeing all the attendees and everything like that.
Okay. How about now?
Yep, we can see the slides, yep.
Okay.
I don't know. Now I've forgotten how to get you to do that. There must be a way, Jack, but I'm not so certain how to instruct you to do that.
Okay. Well, I apologize, everybody. I can't grab the pen, unfortunately, with our problems we're having with WebEx. This chart right here that are shown, you should be seeing the German exports to the U.S. And again, the purple line there is the U.S. dollar index. The black line are exports from Germany to the U.S. And you'll notice that it was a fairly fairly tight correlation from 1992 on as the U.S. dollar index increased in value, German exports to the U.S. increased in value, and then we saw a big decline in the U.S. dollar bear market started, and at the margin, exports from Germany declined slightly, as would be expected according to the theory that currency rates are the main driver here. But again, you notice that period from about 2003 on where we saw a big divergence there, and the German exports started increasing again as the U.S. dollar continued down, breaking that correlation of currency values versus exports. If the currency value were so important and such a key driver here, you think of it the other side of the fence. Germany's currency is going up tremendously against the U.S. dollar in this picture. The euro is basically would be the mirror image of that purple line there, and yet their exports continue to expand to the U.S. and elsewhere. And Germany is a very, very good anecdotal example of this idea that currency rates in exports are much more complicated than the simple lower the value of a currency and exports will increase. Germany, for many years, has run a high currency relative to their competitors, not just since they've entered the euro, and yet they've been an export dynamo for a very, very long time. They were the world's largest exporter in 2008. Germany was, with a very strong currency compared to both the U.S. And China. So that alone, I think, pushes that canard out the window. Why is Germany so strong in the export side? Well, it isn't because of cheap labor. They have very high quality labor force and very, very high labor rates and very good benefits for German workers. One of the reasons Germany is so productive is because they have a massive amount of capital accumulation that they've used to build plant and equipment and reduce the effective cost relative to their competitors and increase the quality of the goods that they continue to export. So there's a perfect example, and again, I think capital formation is the driver here, and it has very, very little to do with weakening the currency. And this is again is a good example that you can use on people when they try and tell you it's all about the currency. Japanese exports to the U.S. And again, you notice a similar pattern here, even in Japan. Going back to 1985, again, the purple line versus the black line. The black is exports to the U.S. As the U.S. dollar fell in value relative to the yen back in 85, we saw a little tapering off of exports to the U.S. as the relative value of the yen rose. And then the correlation broke down completely again right there in 2003. 2002, 2003, and exports took off to the U.S. as the U.S. dollar declined. So something has changed there in a very, very big way in the global economy. Again, this isn't to make the case that even though we had the correlation back then, it is to make the case that something changed in 2003, and I'll show you what that is, and I think right now is really the most powerful driver where the dollar is going to go, and ultimately where the other currencies will follow. We need to see a major policy shift, but I'll get to that in a second. But again, we see the same pattern here of exports. You notice how the exports just fell off the cliff, and you saw it in the other chart also during the credit crunch right in here. As the U.S. dollar bottomed, exports fell off the cliff in Japan. They started to fall dramatically in Germany also. Well, that's the problem that the credit crunch has created, and that's why you've seen a massive improvement in the U.S. current account deficit. Remember this first chart, that 50% improvement in the current account means we're buying a lot less stuff from Germany and Japan, and therefore the current account has improved, and it hasn't been based on another 30% depreciation in the U.S. dollar. It's a change in the savings patterns and spending patterns of the U.S. consumer primarily because of the credit crunch.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.